Next time you get paid, there are 3 things that I want you to do with your paycheck that will allow you to build more wealth from your salary. Number 1 is figure out how you can get some of your money back from the IRS. If you work a job, you get a salary, your taxes are automatically deducted from your paycheck. Well, many Americans are overpaying on their taxes, and this is where, unfortunately, it's your job to figure out how you can get some of the money back. Number 2 is figure out how you can systemize your money, or as what some people like to call it, give a job to every dollar that you earn. This is what wealthy people do. Wealthy people give every dollar that they earn a job. That way they know what to do with the money. That way they don't accidentally blow all of their money, because if you don't blow all of your money, that's going to give you the opportunity to 3, grow your wealth as well. But in order to do this, you need some money left over from your paycheck, because you're working hard to generate an income. You want your money also working hard to make you wealthier as well. And that money that you have working for you can work 24 hours a day while you can't. And this is what wealthy people understand. But in order to do this, you have to understand this. But let's start by talking about number 1, how can you get some of your money back from the IRS? Now, of course, I got to start this section with a little bit of a disclaimer, because although I am a licensed attorney, I'm not your attorney. So if you have specific tax questions, please talk to a licensed tax advisor in your area, because, well, if you mess around with the IRS, not only can you get hit with a big fine, but you can also end up in jail, and neither of us want that, right? So let's talk about taxes. When you get paid with a salary, your taxes are automatically pulled out of your salary. So if you get a job that's paying you, let's just say $50,000 a year, what happens is the first thing is you're going to pay taxes. And now most Americans will not even know or care about how much money this is, because this money is not with your bank account. You will end up with something around $40,000 depending on where you live. Now these taxes are going to be your federal income taxes, your state income taxes, and then you also have your FICA taxes. Taxes, and taxes. Now, the question that you should have is, how can you get some of this money back? Because you earned $50,000, but you only got to keep $40,000. And the way that you do that is by understanding a little bit of how the IRS tax code works. Now, the most obvious and most accessible thing that people have is, well, you can invest some of your money into something like a 401k or an IRA, because these traditional 401ks and IRAs will allow you to invest some of this money, your salary, tax-free into these accounts. You can compare that to something like a Roth IRA or a Roth 401k, because a Roth 401k and a Roth IRA mean that you invest this after tax dollars. So you pay taxes first, and then you invest what's left. Now, the option that's going to be better for you, whether it's a Roth IRA or Roth 401k versus a traditional 401k or traditional IRA, is really going to depend on your personal financial situation, because the argument that everybody likes to make here with the traditional accounts is, if you don't pay taxes today, you have more money that goes into your accounts. Your money can grow tax-free, and then when you pull your money out, well, you pay taxes at the end. And when you're 65 years old and you're retired, you're going to have no income. So now you can pull your money out at a lower tax bracket, hopefully, and have less taxes that you have to pay. That's the hope. However, there's a couple concerns with that, and a couple issues I do want to address. Number 1 is that we have no idea what tax rates are going to be in 10, 20, 30, or 40 years. So there's a chance that tax rates could be higher, especially considering the growing level of national debt that we have. Of course, that's a big question mark, but that's something for you to consider. And number 2 is, what type of income do you expect to have when you retire? Is your goal to have no income, or is your goal to have a whole bunch of income, depending on what you do with your money and your other business ventures or whatever? If you plan to have no income, then sure, that's probably a good option, because if you have no income, then just lower tax brackets. But if you plan to invest for cash flow, if you plan to start your own business, if you plan to have some career that's going to give you a big income in the future that you don't want to retire from, then that could be problematic, because now you have a high income, higher tax brackets, and potentially higher tax rates. So that could be a con for somebody who's thinking about the traditional. For the Roth, the idea here now is you pay taxes today, and you know what tax rates are today, and then your money is going to grow tax-free, although it's starting with a smaller sum of money. And then when you turn older, you're ready to retire and you start pulling this money out, you can generally pull the money out tax-free, and you no longer have to worry about what tax rates are, because you paid taxes in the beginning. Now, this is where, again, you got to decide, is this going to be better for you? If you plan on having more money in the future, if you don't want to have to deal with potential higher tax rates in the future, because nobody knows what tax rates are going to be next year, let alone in 40 years, well, this gives you a little bit more certainty. So you just got to figure out which one's the right option. After this, the next thing you want to think about is maximizing your deductions. Now, even though you are a salaried person, it might make sense for you to go out and pay for an accountant's advice once in a while. You don't want to pay $10,000 a year for an accountant or even $5,000 a year, but maybe a few $100s every once in a while to get some basic advice on if you are maximizing your tax deductions or not. Because as an attorney who's not your attorney, who spent a lot of time studying tax law, what I can tell you is that the tax law is very complex. And well, there's a lot of deductions out there that most people don't even know about. And this is where it's very important for you to understand if you are maximizing your deductions or not, because you want to make sure that you can get the biggest and best write-offs possible, and they are changing year after year after year. So that's the second thing you want to consider, is talking to a tax advisor. Then the third thing that you want to consider, which is the least accessible, but can give you the biggest write-offs and some of the most money back, is creating your own income as well. Working to create your own side hustle, even if you have your own job. It doesn't have to be a major side hustle, just something that you want to work on the side. Maybe it's a little hobby YouTube channel, maybe it's a blog that you want to build, and some sort of side business. Because the reason is, now when you go out to create your own income, you become a small business owner. And when you're a small business owner, you open up a whole new world of deductions. And what is that world of deductions? Well, as a small business owner, you get to deduct ordinary and necessary expenses to run your business. So let's just say, for example, you wanted to start a cooking YouTube channel to share your great recipes on how to cook carrot cakes and everything else. Well, in order to run this business, what do you need? Well, you might need a laptop to run this business. That could potentially be a business expense. You might need a cell phone to run this business. That could be another business expense, not to mention all the other carrier fees and stuff to have that cell phone. Maybe you need to do a kitchen remodel in your house to have a nice kitchen to make these videos. That could also potentially, arguably, be a business expense. You might not be able to deduct all of it because that kitchen is also being used for personal expenses, but there could be a portion of that renovation that could be used as a deduction. Again, this is where now, if you're working to create a new income, if you're working to build your own business, now you have opened up the doors to ordinary and necessary expenses that you can write off. And so now, if you are working to create an income, if you're working to build a side hustle in addition to your business, now you can finally make these deductions because, well, these deductions are reserved for business owners. But anybody can be a business owner. You don't have to be making millions of dollars a year to classify as a business owner. You could start a blog, a YouTube channel, some sort of side hustle to start trying to generate an income. And if you're working to generate an income and you're generating some income and you have some expenses, well, now you can, and I recommend you work with an accountant here, but now you can write off some of your expenses, which could help you get some of your money back from the IRS. But again, this is where things get a little bit more complicated, and I'm going to say this one more time, this is where it becomes extremely important for you to begin working with a licensed advisor. That way, you can keep the most money in taxes. The second thing that you want to do is you want to create a financial system with your money or give a job to every dollar that you earn. By the way, I should also mention that I did an interview with my accountant on different tax breaks that you could potentially qualify for. If you want to watch that video on YouTube, I'll link it for you down in the description. You might find some value in that. But now, when it comes to giving a job to every dollar that you earn, the key thing that you have to understand is that some of the money that you earn is going to be used for your spending. Some of the money that you earn has to be used for your investments, and some of the money that you earn should be put aside for your savings. Now, the reason why this is so important is because most people earn money to spend money. Most Americans are working to spend money to buy a faster car. Most Americans are working to earn money to spend their money on a new vacation. Most Americans are working to earn money to spend their money at Gucci. Now, while that's nice, the reality is that's never going to make you wealthy, period. What wealthy people are doing, and people who aspire to become wealthy are doing, is the first thing they do is they understand, I cannot spend all my money. If I earn $1,000 after taxes, I cannot spend all this money because then you have no money to actually build any wealth. And then the next thing that people think is, well, okay, if I want to build wealth, I earn $1,000 after taxes, I'll spend most of it and I'll save the rest. I'll save $100 out of my $1,000, I'll spend the other $900 and I'm good. Well, I hate to break it to you, but you will never, ever, ever be able to become wealthy by saving your money. This dynamic of saving your way to wealth does not work in today's economic climate. Maybe it worked for your parents or your grandparents, but it does not work today because of inflation. Your savings are not growing fast enough to keep up with the rising cost of living. So now, what do you do to combat that? You have to invest your money. Now, this can become scary, especially if you didn't grow up in a household talking about investing or financial education, because when you hear the topic of investing, you think risk. What if I lose my money? What if the stock market crashes? What if something happens to the real estate market? What if the economy goes down? I could lose half of my money overnight. Well, yes, that is a risk, but there's also a risk of you not investing your money. Because if you don't invest your money, well, not only are your savings going to lose value to inflation, which is a guaranteed loss, but the money you spend is a guaranteed loss as well. Because when you take that $1,000 and you spend 900 of it at Gucci, at Lululemon, at Chipotle, all 900 of those dollars are gone and you're never going to have a chance to see any of that money again. And this is where what wealthy people want to do is they want to emphasize this. They want to invest their money aggressively because this is what's going to allow you to build wealth. Now, I'll talk about the different ways that you can invest your money in part number 3, but this is where now you have to give a job to every dollar that you earn. And one of the things that I like to do is create 3 different bank accounts. Have a bank account for your spending money, have a bank account for your investing money, and have a separate bank account for your savings money. And the reason why you want to create 3 different bank accounts is so you accidentally do not spend your investment money. Because when it's in 3 different bank accounts, you're going to look at that money very differently. If you only see $650 in this account, and you go into that store and you see the $1,000 phone that you cannot finance, well, now you're going to realize, oh, I don't have the money to buy that phone. And it's going to make you think twice as opposed to if you had all the money in one account. So the simplest thing that you can do is go to your bank, create 3 different bank accounts, and then you can create an automatic withdrawal and deposit, which says that now every time I get paid, some of this money is going to go into this bank account for my investing money, and some of this money is going to go into my savings account, which holds my savings money. Now you can find the right percentage that works for you. One of the things that I like to say is something like a 75, 15, 10 plan to start, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend, 15 cents is the minimum that you should be investing, and 10 cents is the minimum that you're saving. Now, when it comes to your savings, there is a cap to how much you should save, and that cap is going to depend on really your financial situation, because your savings are not there to make you wealthy. Your savings are there to protect you against a financial emergency. Your savings are there to protect you in case your car breaks down, in case your window breaks, in case your kid's arm breaks. That's why you want to have savings. That way you have some cash to fall back on, so you don't have to go into credit card debt when life happens, because let me tell you something, life happens. That's why it's called life. So how much savings should you have? Well, somewhere between 3 months and 12 months worth of expenses, depending on where you are in life. If you're 24 years old, you don't really got any financial expenses or liabilities, and you're open to taking on a whole bunch of risk, you don't need a year's worth of expenses saved up. Be more aggressive with your investments. You got time on your side. Maybe you only need a few months worth of savings. Now, if you're 45, 48 years old, you got kids you have to save up for, you have a spouse to take care of, you got other financial liabilities you want to take care of, now it makes sense for you to have 6 months, maybe 9 months, maybe a year's worth of expenses, depending on where your risk tolerance is. If you don't really have a very high risk tolerance, then you can have a bigger savings cushion. If you have a higher risk tolerance, then maybe all you need is 6 months. But this is where you have to kind of think about how much money do you want to save. Once you hit that savings goal, then what I want you to do is take this 10% that you're saving and put that money here into your investments. That way now, instead of investing 15%, you're investing 25% of your income because, well, you've already built the savings cushion. More savings is not going to do you any more good. So take this money, put it into your investments. Now you can invest more aggressively. But now what you're doing is you've assigned a job to every dollar that you earn, and your money is automatically being transferred. So you built a system for your money, and now you know I cannot spend my investment money because this is the money that's going to make me rich. This is the money that's going to make me look rich. Most people focus on looking rich more than they do on actually getting rich, and that's why most Americans are product rich but investment poor. But if you really want to become wealthy, you got to become investment rich, and well, I guess you don't have to be product poor, but if you sacrifice some of this, well, that's going to allow you to become wealthy here. It's kind of the ironic thing that the people that look the richest oftentimes don't have the assets to show for it, but the people who have all the assets, they don't feel the need to show it off the way that somebody who doesn't have the assets needs to. Now, whether or not you want to buy the Gucci, Louis Vuitton, I'm going to leave that up to you, but the key is I want you to own the assets first. Once you understand this is where you have to understand number 3, how do you grow your money? How do you invest your money? How do you build that wealth? Now this is where things really start to get fun, because when we talk about growing your money, the whole idea here is you're now putting your money to work. That way it can work and generate you money even when you're not working. And this is where real financial education comes into play. And if you do like learning more about this type of stuff, I do want to let you know that we have a free ebook on how to build wealth as an investor, even if you don't have any experience as an investor. This is an ebook written by my company, Briefs Media. It's completely free. I got the link for you down in the description below. But it walks you through how do you build a financial system, how do you build a wealthy mindset, how do you save your first couple $1,000s, how do you start generating cash flow from your investments, different investment ideas, and just kind of walks you through step by step different things that you can do to start investing your money, building your wealth, and potentially generating cash flow, depending on how you want to invest your money. So if you want to read this ebook, it's completely free, and I got it for you down in the description. Now, the whole idea behind growing your money is you're taking the money that you put aside towards your investments, and you're going to use this money in the most strategic way possible. That way this money starts to grow and could potentially create a new income stream for you without you having to work. But there's a couple things I want you to understand about this. Number 1 is, let's talk about some ideal returns when it comes to investing your money. Because when it comes to investing your money, you have a lot of people on the internet talking about, oh, throw your money into this investment and get a 200% return. And well, that sounds exciting. It's not sustainable. And while some people could get that 1 year, maybe 2 years, maybe 3 years, it's not sustainable. And the fast money is also the fastest money to go away. And so if we talk about sustainable returns, generally what you have seen in the past from the historical stock market returns is that the stock market and the real estate market generally grow by an average of 7 to 10% a year. This is what we have seen over the last century. Now, does this mean that the stock market and real estate market always grow by 7 to 10%? No. This is an average. That means some years it grows more, some years it grows less, some years you see losses. We have seen market crashes. We've seen real estate crashes. This has happened many times over the last century. But after factoring in the crashes, after factoring the big boom years, this is what we have seen as the average. So when you understand this, I also want you to play this against debt. Because if you have any sort of high interest debt, maybe you have credit card debt, and if that credit card debt is costing you, let's just say 18% a year, well, now let's think about this. Your credit card debt is costing you 18% a year. When you go and invest your money, you're trying to get a 7 to 10% a year. Which number is bigger? Now, you might be wondering, why am I saying it like this? Well, because I have seen many people with 18 to 28% credit card debts that are asking, how should I be investing the rest of my money in the stock market? And this is where I want you to understand, you're trying to get a 7 to 10% return in your stock market portfolio or real estate portfolio. But if you're paying 18% on your credit card, it makes more sense for you to take your investment money and work to pay down your high interest debt first. Because if you can stop paying your credit card debt 1 year early, that is a guaranteed 18% return on your money. Now, if you take the same money and you put it into the stock market, you might be able to get a 7% return. You might be able to get a 10% return. You might be able to get an 18% return, but you might also lose money. So now you have risk here. You could make less. You could make the same. You could make more, but it's risky. This is guaranteed. So if you have high interest debts, one of the things that I always like to say is pay down your high interest debts, your credit card debts, before you go out and start talking about how do you invest your money in stocks and real estate. Now, the next question everybody has is, well, where should I put my money? Should I put it in stocks? Should I put it in real estate? Should I put it in ETF? Should I put it in index funds? Should I put it in mutual funds? Should I put it in individual companies? And this is where you can really get overwhelmed with the amount of options that are out there. Because now you might see the next hot stock, you might hear about Tesla on the news, you might hear about Apple on the news, you might hear about this brand new mutual fund on the news. And the reason why many people don't become wealthy isn't because they picked the wrong stock, or it's not because they picked the wrong mutual fund, or it's not because they picked the fund with the wrong expense ratio. It's because they never got started. Now, of course, there's a con to picking the wrong investment. However, the key to building long-term wealth is getting started. Because even if you pick the wrong investment, at least you're getting started. And what happens, even if you make the wrong investment, is you are starting to learn. Losing is a part of the process, which you'll see in pretty much every one of my disclaimers, is you're virtually guaranteed to lose money. Every single successful investor in the history of time has lost money. And if you're really scared about losing money, well, then you're never going to get started. And if you never get started, you're never going to see the success. But in order to get the success, you got to get started and you have to be willing to lose money because unfortunately losing is a part of the process. However, the goal is to make way more than you lose. Because when you have skin in the game, when you actually start investing your money, you're going to be much more willing to learn. And this video can go on for hours talking about how to analyze a stock, talking about how to analyze a real estate investment, and we go over that in the ebook. But what I want you to understand is the first thing you got to do is just get started. You don't got to throw your entire investment portfolio into one thing, but you have to get started. Start with $10. Start with $100. Start with something you're very comfortable with losing. Understand that when you invest that money, you could lose all of it. So don't go and just dump your entire life savings into an investment, but get started slowly, dip your toes in the water, and then start learning. Because then what you're going to realize is maybe you hate the stock market, maybe you hate analyzing individual companies, and you just want to throw your money into an S&P 500 ETF, meaning you just want to invest your money into a fund that's giving you exposure to the largest 500 companies in the stock market. Now, you don't have to worry about analyzing companies. You don't have to worry about trying to time the markets. You just put a little bit of money in every week, and now you set it on autopilot and don't have to worry about it. Maybe you realize, oh yeah, I like analyzing companies. I like listening to earnings calls. I like studying financial statements. I like looking at the balance sheet. I like looking at the income statement. I like valuing a company. And I'm actually pretty good at it. So maybe now you don't invest in these funds. You're looking for individual companies. Maybe you say, I hate stocks. I like investing in real estate. I like being involved. I like working with tenants. I like working with management companies. I like building systems and processes. And so maybe you'll go into real estate. But you gotta get started, because if you don't start, you're not gonna know what you like, you're not gonna know what you're good at, and you're not gonna know what you wanna do. Because the same investing strategy is not gonna work for everybody. Some people are going to work better in the stock market. Some people are going to work better with passive investments like ETFs and index funds and mutual funds. Some people are going to work better with individual stocks. Some people are going to work better by investing in real estate. Some people are going to work better by investing in startup companies. But in order for you to figure it out, you have to get started. And the way for you to get started is by, number one, not spending all of your money and having money to invest. There's a lot of people who talk about how can you make more money. But one of the things you talk about is it's not enough to just make more money. You gotta keep the money you make. Why is that so important?
Because anybody can make money. Because if you're making $1 million a year and you end up living check to check, the guy who's making $100,000 a year and has $25,000 saved is more wealthy than